thank you for everyone for being here and for dealing with a little bit of the chair confusion. And appreciate all the other panelists we've had today. So start really quickly. I'll just allow all of our panelists to introduce themselves, talk about what they're working on, and then go ahead and talk about a little bit about why they're excited about stablecoins. Let's start with you.
Hey everyone, so my name's Guy. I'm the founder of Ethena Labs. We are a synthetic dollar issuer, so the construction of the product looks quite different to the other issuers who are sitting on stage. It's crypto-backed, and we use derivatives to peg the asset to the dollar. We came out to market about 4 months ago in late February, and since then have grown to just under $3.5 billion of supply, which is around 2 times the size of the RWA tokenized treasury market that sits on chain now.
I'm Nick Van Eck. I'm the founder of Agora. We launched actually yesterday a new US dollar stablecoin. So what we're doing differently is we sort of use stablecoin 1.0 as Tether, then you 2.0, which is these exchange-backed stables like USDC, BUSD. We're neutral money. We work with various businesses, and then for them providing services to us, we share net income with them, right? So that could be a DApp, it could be exchange, fintech, whomever. All of our securities are overnight reverse repo, short-dated U.S. Treasury bills held in one of the 3 largest global custodian banks, oversees $40 trillion in assets. We had about 20 million come in yesterday, 15 million will come in today, and it should be at 40 to 50 million in AUM by the end of this week. I think that makes us the fastest growing stable ever, Rob, in the first week. I don't know.
You would know better than me.
That's us.
Congrats. Thanks for having me. Guillaume from Societe Generale Forge. We're a fully owned subsidiary of the bank Societe Generale, dedicated to digital assets. So we've been tokenizing bonds and structured products since 2020 when we did the tokenization of the first EIB bond for 100 million euros in 2021. Since then, we've been tokenizing more bonds, more structured products, and we recently launched a stablecoin that we've been using as a settlement instrument for all the products that we're bringing on chain. Last but not least, we obtained the MiCA license on Monday together with our friends from Circle. At the same time, I would say.
Well, love the tee up. So nice to meet everyone. Matt Stafford at Circle. I lead our ecosystem partnerships team. So that's basically all of our relationships with crypto exchanges, blockchains, and DeFi. I think everyone knows USDC well enough not to have to introduce that. But we're pretty excited, about our MiCA licenses for both USDC and USC, and hopefully get to talk a bit about that.
Hey, I'm John. I run crypto at Stripe. Stripe is a payments company. I imagine many of you have heard of, traditionally in the Web 2 space, but moving pretty quickly into Web 3. We have a series of different crypto products that we offer. Our team helps with enablement for existing crypto organizations who want to use Stripe for their payment processing. We have an on-ramp that helps consumers on-ramp to Web 3 organizations. We have a payouts product for global payouts on USDC. And most recently, we announced acceptance for crypto for all Stripe merchants starting in the US at the end of this summer.
Great. So what's very clear is we have a lot of different types of companies up here, protocols. We have 4 issuers. In fact, Guillaume, I didn't know you were an issuer until just now. So that's awesome. And I think as you think about each of your different products and what you're building, it's in some cases used for the same types of things, right? So it might be payments, but there's also a lot of different types of stablecoins that are used for things like collateral or for savings and investment products or trading, et cetera. How do you guys see your position in the market, and what do you believe that killer use case is for stablecoins today? And maybe I'll start on the Circle side.
Yeah, I think it's hard to kind of deny the existing use case for USDC in crypto trading. We see tremendous traction from exchanges all around the world with USDC as kind of a base trading asset. And I think that's set to continue. But where we're really excited is looking forward to the kind of use cases for stablecoins and USDC in particular for cross-border commerce. So think about kind of the largest merchants in the world, all the way down to the smallest consumers who are looking to move money globally. And right now that's very expensive, and it often takes a lot of time. We're working really hard already with some of these kind of entities to really bring these cross-border flows on-chain through USDC and actually just make it a lot faster, cheaper, and more cost-effective. So the way I see that playing out is super exciting. And I think we really stand to kind of be a major participant in helping to bring a lot of the kind of global commerce flows on-chain and make them a lot more cost-effective and fast.
Maybe just to highlight the problem that Matt is referencing is a lot of businesses today, when they're moving money cross-border, even if it's within their own entities, it can take days, if not weeks, for that money to go from one bank to the other. And so you have capital inefficiency as well as a lot of additional costs, and factoring has become a quite large business. And so the problem is really poignant for a lot of these businesses. And folks like USDC, USDT, our stablecoin AUSD, it sounds like Guillaume's stable as well will be used to solve these use cases. I don't think we're there yet, but I think that is ultimately a really massive market that we're all going to start tapping into pretty soon.
Yeah, I think there's a lot of opportunities. On our side, we're working on 3 different verticals. And what I can talk about is what's happening today and where I see the future in maybe like 3, 4, 5, 10 years. First vertical is about settlement instrument. So using stablecoin to solve the cash leg of like, why use cash to buy a product that is already being put on chain? So you're solving in speed, less counterparty risk, and it's like cheaper to do the settlement as well. In the future, it's going to be even more, like even cheaper than it is today. We're going to move from a place where we're doing a lot of reconciliations, it's very capital intensive and human capital intensive, to a place where there's going to be execution matching, and like at the point we're doing the atomic settlement. Basically solving like all the problems of in middle office, back office, that takes a lot of time, and that costs also a lot of money. Second vertical where we're working with is like corporate treasurers. Everybody knows the use case of transferring value 24/7, cross-border, very cheaply, instantaneously. The future here of stablecoin is going to be using programmable money to solve the problems that treasurers have in managing their liquidity. Being able to do intraday repos, being able to do transfer automatically whenever like this or this is happening in the market is going to be super useful. And the last piece where we're also working is something where obviously Circle is really advanced, is being an access point to the crypto world. The way I'm seeing the use of stablecoin and having like differentiated type of stablecoins as well, maybe like more institutional, is crypto, and in particular DeFi, is where convergence between banks and the crypto world is going to happen. A lot of this stuff that we're bringing on chain, securities, will be used as collateral, and all the loans are probably going to be made in stablecoin.
I think we sort of see 2 non-speculative and then like 1 speculative use case of stables, and that's how we sort of like think about bucketing that by customer segments. So I think it's clear stablecoins are a very clear store of value for people who are on the fringes of the financial system, and I think that's sort of the market that Tether has done an extremely solid job of sort of capturing, which is just I want to store my value in dollars as the least worst fiat currency, and they give easy access to that. I think the emerging areas that I think some of the guys on the stage here are sort of going to be pushing forward with is actually like the area which is least explored at the moment around payments, settlements, integrating with fintech. Sort of think about stablecoins as the connective tissue between crypto and I guess the real world. And I think the piece that Ethena's really looked at and tried to solve for as a niche within that larger bucket is actually just using it as trading collateral and then collateral within DeFi. So I think we like to sort of tell the story that stablecoins are the only non-speculative use case of crypto that like everyone uses. But if you actually just look at the data in terms of when are stablecoins growing the quickest, it's always in the speculative manias of bull markets. So people in Argentina didn't wake up at the beginning of 2021 and decide a stablecoin is that much more useful when stablecoins increased by 30%. It was actually using it to harvest speculation within crypto. And so the opportunity that we're trying to solve for at Ethena is actually the best trading collateral and collateral within DeFi, where you can use it to sort of capture speculative premiums within crypto.
Great. So
Yep.
go ahead.
I was just going to say, yeah, I think like on the payments front, I think it's easy to say, payments is sort of the obvious use case for stablecoins. But I think like, so were credit cards for the web back in 2011, and it was still pretty hard. It was tough for a merchant to integrate. It was tough for a merchant to actually complete a transaction, track their transactions, do an easy integration. So I think Stripe's excitement about this space primarily has to do with how do we bring the like practical use cases, the practical payment use cases to the merchants who are already accustomed to a very plug and play, easy to use, API-driven experience. And I think out of that, they should be getting the same things that you're talking about, which is primarily the global commerce end, right? There's only about 15 14% of the global population in the first world. And we think about that as being like the total reach of sort of your average internet merchant. And in the future, we'd expect them to have access to that other 85%. And so stablecoins give us that, not for free, right? It's still a little bit challenging to get into some of these other countries, but I think it gives us a step function towards it that these merchants haven't seen before. So I think I'm really excited about unlocking that very practical use case in a very real way for merchants. Just in the short term, really, not even in like, how do we do this in 5 years? How do we do this in 10 years? How do we do this in like 6 months? And I think that's right on the horizon, and I think that's like the really exciting future we're kind of running towards.
So John, you just kind of alluded to some challenges that you guys have as you're trying to integrate stablecoins. Is there infrastructure that's missing that you need to interop with stablecoins more broadly? And if that's true, who's building that infrastructure, or who should be building that infrastructure?
I think there's two kinds of infrastructure here, right? There's like hard infrastructure, which is kind of still in its infancy. We need fast, reliable chains, right? We need like preferably well-regulated, well-trusted coins. We also need sort of the wallet ecosystem to continue to improve. That's a lot of the consumer's first experience with holding, with interacting with these coins, with understanding what they have. And then there's also like soft infrastructure, right? There's the regulatory environment, which is evolving, I think, in the EU, is still incredibly young in the US, where much of Stripe's merchant catalog is. So look, I mean, Stripe is an enablement layer for merchants. We're really leaning on all of these partners to sort of catch up and build these systems that can be trustworthy as Stripe sort of is able to lean on them. It's very similar to kind of what credit cards needed to do, right? For like Stripe to come into being, there was an existing and a large amount of trust in like the Visas, the MasterCards of the world. We need the same thing to happen in the crypto space. For a consumer to sort of desire to click that button for crypto checkout, even if it seems, like potentially the only rail, they'll stay away from it. So I think we're in our infancy on both sides, and maybe we're just starting to turn that corner in terms of like name brand, recognizable, sort of well-trusted, well-regarded infrastructure on both ends. And so yeah, we sort of need progress on all of them.
And Guillaume, is that why you guys decided to issue your own stablecoin versus maybe using somebody else's? That's the core infrastructure for your business?
Well, we've looked at various ways to use like a new settlement instrument. We considered like use a CBDC. Like there was an experiment with Banque de France using a CBDC. We could have used the same. Decided we wanted to have something like more private. We also thought of using the same thing as JP Morgan. JP Morgan coin is tokenized deposit. So basically it's commercial bank tokenized deposit. The commercial bank deposit that is tokenized. Very easy from a regulatory point of view. Actually, the regulator loves that. It's easy to pay yield as well, which we cannot do under MiCA rules with the stablecoin. But we also realized that the problem of interoperability is a big issue. You have a tokenized deposit, it can stay only within your bank ecosystem, which is not a problem for JP Morgan because they're huge, but for a bank like Societe Generale, a bit more problematic. So we decided, since we've done everything on public blockchains already, we have this knowledge, why not do a stablecoin that is going to be open, and we can use it for this specific use case, but then like open it to others.
And you're okay if your stablecoin ends up interacting with DeFi?
Yeah, so since last Monday, we announced that, number one, we are MiCA compliant, and number two, that we were opening, removing all the restrictions of transfer. So it's fully transferable. I did it myself. I went on Bitstamp, bought a little bit, put it on my Coinbase wallet, sent it to my Phantom wallet, and it's working perfectly.
That's great. So obviously, there are a lot of issuers up here, as I mentioned earlier. And when you mentioned JP Morgan coin, there's, I think I saw Martin on the from Mountain Protocol before this. Clearly, it's becoming a bit of a fragmented space right now. How do you guys think about the future? Is there going to continue to be just new issuers, every sort of fintech and bank maybe has their own coin? And how do you protect against or compete in that type of arena? And maybe Matt, I'll start with you.
Yeah, it's a great question. I mean, we're engaged with a lot of these companies who are in the process or actually issuing their own stablecoins. And I think that the promise of a stablecoin is quite obvious. It comes with kind of like baked-in yield. The economics on paper seem really good, but the reality is it might actually work within their own closed ecosystems, and they might actually see some success with moving money between different participants in their own ecosystem. But we believe that the moment that the consumer or the user actually wants utility from that stablecoin, that's where you hit the kind of problem. And that's what we believe takes a really long time to work with an entire ecosystem to kind of build that utility and ubiquity outside of these partners. So I think the trend's probably going to continue. But I think over time, I think a lot of these companies are also going to realize that there is value in having connectivity to a much broader world to be able to kind of participate in some of these use cases that we've talked about. So that's kind of our point of view on that.
Yeah, I think our view is very similar. What really matters about a stablecoin is the utility and the liquidity. And the challenge is if you're JP Morgan and you have JPM coin, right, and it's just your tokenized bank deposits, you're not actually bringing net new deposits to JPM. And also, hey, you go to Morgan Stanley, they're going to say, we're not going to use JPM coin, we're going to use Morgan Stanley coin. Right? And so I think issuers like USDC or AUSD with us, we want to be that neutral layer of interoperability and liquidity across payments, bank deposits, wherever it is. And it's like you can sell into our stable, and we're that liquidity layer that Tether really is today. But I think as compliance takes over crypto and the broader space, like they're going to look for audited, trusted stablecoin issuers like USDC and AUSD. I think there will be plenty of siloed sort of tokenized bank deposits or stablecoins themselves that are one-to-one, but they'll kind of just stay within their own ecosystems, and there will be real back-end efficiencies for those organizations, but I don't think they actually capture net new share that someone like USDC or us does.
Yeah, I totally agree with what these guys are saying, and I think it's quite interesting, I think, to just think about the evolution of the use of stablecoins and how we've seen specialization actually evolve through time. So in the beginning, it was just about trading collateral, and getting in and out of Bitcoin and ETH was really the only use case of stables. That obviously evolved into emerging markets with holding it as a store of value, and then now you're seeing all the payments use cases and like the emergence of DAI and DeFi. We think that continues massively, and that wouldn't be a great outcome if stablecoins were a small market, but at 150 billion, and I think we all on the stage sort of agree that number is going a lot higher in the next few years, actually just being a specialist within a use case in that broader market is still an enormous opportunity for people to go and capture. And so I think from our perspective, that's one thing that we focused in quite a bit on, which is how are you very different, and what are the qualities that you're trying to solve for that look very different actually to some of the normal fiat stablecoins, and just making sure that you do that very well to serve the customer segment well.
Guys, so you're the second biggest DeFi stablecoin today, behind Maker, I believe. In DeFi, we've clearly seen a lot of fragmentation, and there's been a lot of copycats of Maker, of Ethena now, because of your success. Do you see that siloing happening differently and in a more exaggerated fashion in DeFi than it maybe happens for the more centralized use cases? And how do you see the centralized use cases? Because obviously USDC is used heavily in DeFi, and them coming in and interacting more with DeFi. Is there a kind of a different market dynamic there for you?
Yeah, I think both the on-chain and off-chain stablecoins follow a similar power law that you see with most of these things. It's like 70 to 80% market share with the two winners, and then a very long tail that sort of exists after that. I think the piece that people forget about stablecoins is that at small size, it's actually a really shitty business model, and a lot of people don't make any money at all. And then there's like a level of escape velocity when you reach there that it becomes like really interesting. And so I think our view is actually there will be one or two winners within the DeFi category of stable issuers, and like beyond that, it's just an enormous long tail of sort of just wasted capital that's actually sitting there. But I do think that there's interesting new areas for entrance, especially what Nick's doing with Agora, which sort of sits there to sort of challenge the larger market opportunity that sits within CeFi, I think.
Nick, you mentioned the silos earlier when you were giving that answer. Do you believe the siloing will happen, more around different use cases, and how will, maybe Agora be used for those different use cases, or will there be a collateral-specific stablecoins or, savings-specific stablecoins? What do you expect, or how do you expect that to play out?
Yeah, I think there will be sort of like a class of a catch-all stable, right, that serves, both as a quote token, as a payment token, similar to how USDC serves today, and a variety of use cases. And then I think there will be maybe more specialized stables that may focus just on high-frequency trading firms because they have really good connectivities into banks and can have like super low latency on and off ramps. Like those could exist. I also think geography is going to play an important role into this. So if you look at the market today, USDC has really good share across the United States and Europe and a lot of Western countries, but USDT dominates in Asia and in Latin America, and I think that'll continue to exist. I think you'll have a lot of different silos based on geographies. But maybe to touch on your last point, collateral, I think overnight reverse repo, short-dated U.S. Treasury bill, one-to-one stables are the best model from a reserves perspective. And then if you look at different collateral structures, I think they're fundamentally different products because they may have T+2 or T+3 if you're in more illiquid objects, right? So I'd say USDC, AUSD are the most liquid, and then if you look at things like DAI, right, you probably couldn't unwind DAI in a few days, whereas you could unwind USDC and AUSD, probably in a day, even at the scale that we are now, because of the collateral that's backing it. And so you also kind of get into different products. What do people want, right? USDC, AUSD, I sort of view us as digital cash, really high utility. You can use this anywhere in the world. Okay, well, maybe you want just yield, and you're really like low velocity capital. Well, then maybe a tokenized treasury equivalent, sort of stable, is a better option, right? But that I think is a completely different product, and then obviously you get into more, let's say, less liquid types of collateral or higher risk types of collateral. It's just a completely different product overall, different market.
Does that change the way, and I think this is for all three of the centralized stablecoin providers here, but does that change the way you think about growing your business and what your product set is supposed to look like in the future? Or is it, hey, we're going to build for one core use case, we're going to try to capture that, and we'll let other people go and build for those other things?
I mean, I would say, we're most focused on kind of like aligning ourselves with kind of like trust, regulatory compliance, and really any use case that wants to kind of align with those set of principles. And so that could be large enterprises who kind of are waiting for regulations to come into play to adopt stablecoins for use cases that make a lot of sense, but they're not going to do until regulation comes in. It could be DeFi that wants like a trusted kind of secure stablecoin for their use case. But I think like we're very much kind of like playing this long game of aligning with regulation and aligning with trust, transparency, and compliance, and we're exploring the use cases and the companies that want to kind of align with that. And that's the kind of approach we're taking, less of a use case specific specialization, but more of a kind of like specialization around regulatory compliance and kind of like trust and transparency.
Yeah, on our side, like we're working on these three different verticals, and almost every time there's also like an internal discussion to have, because we're kind of disrupting our own business by introducing the stablecoin, which is also interesting.
Yeah, I would say the way that we think about it is playing for the market now with like the market that's going to be around in 3 to 10 years also in mind, right? So where stables are most used today is, as quote tokens on exchanges or as collateral in DeFi. Do I think that is the largest use case for stablecoins in 5 years? No. I think it's going to be cross-border payments in traditional businesses that are using stables to move money globally. But we have to play for the market today, and so where we're focused is building up, one, liquidity on chain, and then two, on centralized venues, which might have an appetite to work with a different issuer because we're not aligned with Coinbase or other reasons, right? And so I think we're sort of focused on winning crypto as it is today, which is trading, collateral. But I think 5 to 10 years from now, our hope is that our core customer base is like global payroll providers or commercial banks or businesses like Pepsi. Like my dream would be for Pepsi to be using AUSD is like they move money from Mexico to Australia, right? And are working with different commodity producers and bottlers in different regions. Like that's who I want my customer to be. In 10 years, we are nowhere near there. But I think it's focusing on crypto now and then thinking about where we're going is how we kind of view the world and the market.
So John, we're talking a lot about this fragmentation. When you think about it from a Stripe perspective, how do you think about, okay, well, do I support all of these? Do I want to support all of them? Do my customers want to support or want to accept all of them? Or do I need to pick one or two? And how's that work done for you?
Yeah, so I think on the front end, on the consumer end, I think there's limited ability for an awareness beyond a small number of coins. I think it's just sort of where consumer activity tends to trend towards. We probably have a countable number of stable coins at the end of the day that consumers recognize inside of their wallets. I think on the other side, on the back end, I think there's unlimited opportunity to provide coins that are useful to individual institutions, individual use cases, individual sort of executions. And I'm not actually entirely sure how this plays out. In the short term, it unfortunately means a company like Stripe has to kind of go and pick and choose. And we do that mostly under sort of the regulatory requirements that are in front of us, which helps us sort of whittle down to what's currently available. Long term, that'll probably look the other way around, right? That'll look a lot more like what are the consumers demanding? What are they using? What are they expecting? What do they have in their wallets today? And I'm really like, I can't predict that farther than probably 6 to 12 months out. I think there'll be some interesting shifts that happen. I think it might be driven by the wallet providers. I think we're already seeing a trend towards not necessarily exposing the network that the coin is on inside of a lot of wallet providers. I know Coinbase is sort of doing this a little bit. We're seeing it a little bit more in sort of the MetaMasks and even the Phantoms to a certain extent. And I think like as that starts to happen, they're going to also have to start to abstract out a little bit like what does it mean to have a coin and what coins are able to land in there. And so I'm sort of hoping it doesn't end up being Stripe's responsibility to go and do all of those translations in the back end. You know, our sort of preference would be a lot of that translation happens before it gets to us. And then on the back end, once it's sort of been dropped down to the merchant, maybe the merchant has preference or the activities the merchants are participating in with their financial institutions determine the back end coins that are being utilized. But I think the life cycle of a payment from like the moment of consumer decision through to sort of the settlement and beyond doesn't necessarily look like one coin the whole way through. I think we're going to see interop happening. And I think it's one of the weakest parts of the stablecoin ecosystem today is that interop between the coins as it passes through. And I'm frankly pretty excited to see what the partners are that come together. Love to see all the stablecoins work together to solve this problem. But I do think on the consumer end, I would be surprised if there was a future where consumers were grappling with 1,000 coins and trying to make a decision, and where Stripe was attempting to accept all of them.
Do you think, and because you kind of just mentioned, okay, well, hopefully we'll take some feedback from the consumers and the merchants, like what they want. Do you think they care? Or is it just digital representation of a dollar in the same way we might have it now, but it's better technology, but do they care if they have USDC or AUSD or anything else? I think
it's 50% a utility funnel, right? Like where's the most useful thing and how have I gotten it? And I think the other 50%, frankly, is brand recognition. I think it's pretty important right now for coins to have external brands. I think they have to play that role. I think they have to expose to the consumer who they are and explain their value proposition the same way that the credit card networks had to for years to explain why would you use a Visa, why would you use MasterCard, why would you use American Express. I don't know exactly how that falls between the PSP and the coins, but I think today, we're sort of, it does matter. Do you have like a strong social presence as a coin or as a network? And I think that does today at least drive consumer preference. I think that's a positive thing, by the way. I think rather than like a large mega corporation sort of pushing a coin and saying this is what you're all going to use, I think we're sort of in a moment of very pure, almost like democratic decision making, and it's pretty greenfield. So that's kind of how I think it'll play out.
So we've talked a lot about regulation, or at least people have alluded to it up here. Obviously, we're in the EU right now. MiCA is a hot topic. Has been for a while, but definitely over the last couple of weeks. Circle obviously became MiCA compliant, or announced they were MiCA compliant last week, and Societe Generale, of course, announced they were as well. And I think we've seen, in Hong Kong and Japan and other parts of the world, Singapore, there's been a desire to get, regulation, done to allow for, digital money in a way that we haven't necessarily seen it in the U.S. And so, how do you, maybe Matt, from the Circle perspective, see, that playing out, and how does that affect the way that you go to market and the way that you decide, what products to support and how to integrate, et cetera?
Yeah, I think, again, we want to be very aligned with how kind of like governments and regulators are thinking about emerging stablecoin regulation. We spend a lot of time actually with governments and these bodies kind of really helping them kind of like think through what is the right way to roll out regulation, how do you make it kind of like usable and kind of actually not kind of inhibitive. And so we want to be a part of that process. And so we are working with these different kind of like governments and regulators around the world to kind of establish these regulations, because our hope is that once those are established, that will open up a whole range of use cases across not just the kind of current crypto use cases, but major enterprises across financial services and technology and others. So this is going to take time, and I think MiCA is the first kind of like clear example outside the US where, there's regulation that's come through. We've invested a lot to be compliant, and who knows, it's early, so we'll have to see how it all kind of like plays out. And I think US-denominated stablecoins are for sure going to play a continued role in all these different countries, just given the place that the dollar plays in global trade. But with EuroC, for example, we'll see how that starts to pick up. And I think with Mika in place, it at least provides the frameworks and the kind of like guardrails for how organizations can interact with this new digital currency and what sort of activity we pick up. So that's our kind of general approach there.
Yeah, on the Mika side, like obviously it's changing a little bit the landscape because the hurdle to be compliant are quite high. But it's also leveling the playing field with other instruments such as tokenized deposits. It's great that corporates can now use a stablecoin where there's a clear definition, there's a clear rule in terms of what assets can you use as collateral and so on. And hopefully that's going to help with the adoption of stablecoin in Europe.
So, Guillaume, you just kind of mentioned this, that the hurdle to operate under Mika is pretty high. And I think there is, while not knowing anybody's specific economics, there's a debate going on that, potentially, operating in the European Union for a global stablecoin provider might not be unit economic positive, or it is a drag on your return on equity as a global provider. And it's clear, at least in my mind, and some people can disagree, but that the European Union wants that because they want to incentivize maybe more local issuers versus global issuers coming in. I think we're seeing a little bit more of that happen in other types of localities as well. And then, we have people like Paul Ryan, writing Wall Street Journal op-eds about how the, U.S. dollar stablecoins are good for the U.S. debt crisis, and it's good to protect ourselves in what could potentially be a currency war with people like China. With all that context in mind, is there a possibility, or do you guys see a possibility of there being, call it this, currency war happening and playing out through stablecoin proliferation in ways that it hasn't necessarily happened in other places? And could that mean that we have to have, not just U.S. dollar stablecoins, but there is going to be, and it will look like the traditional FX market where there's, Hong Kong dollar, Euro dollar, et cetera. I don't know, maybe Nick, if you want to start.
Yeah, I think the capital efficiency is one thing. I think the bigger elephant in the room is that it forces you to have your deposits in European banks. I think we all know, or at least folks that were around last year know why having bank deposits backing a stablecoin is potentially problematic versus having it be like overnight reverse repo or U.S. Treasuries. So I actually think that's the bigger issue. I'm curious how they're dealing with it at Circle. I'd love Matt's perspective on that. Like that's like outside in, right? We're issuing outside the EU. We have our VASP. I don't think we're planning to get an EMI license anytime soon because of the capital efficiency point, but also because now we have to keep deposits in European banks, and if we want to protect the assets of holders of AUSD, like I want those in the most liquid and secure custody banks and securities available, right? Which is overnight reverse repo with the Fed and short-dated U.S. Treasury bills. And under Mika right now, you can't do that. So we're also making an operational decision as a business. We want to look out what's best for our customers. Sure, you're regulated, but if the regulators are asking you to do something that are probably not in the best interest in protecting the assets behind your stable, then do you want to operate in that regime? And for us, the answer is no for the time being. But I do think Mika was intended really just as like a starting point, and there's a lot of amendments that they're planning to make. One thing that people also don't talk about is like, under Mika, you're technically not GDPR compliant because you can't roll back transactions on Ethereum, right? And so you don't have those privacy-preserving mechanisms that European businesses are supposed to adhere to. But they kind of, let that go under the rug, right? And the regulators don't care about it. But that's our general view. I think Mika is a great starting point, and it's certainly a lot better starting point than the United States and where we're at back home. It's a little bit silly that, we're not even issuing in the U.S. because of there's no clarity, right? But, hopefully we get there soon.
Yeah, I would just say, so we're spending a lot of time, we've invested a lot in Circle France, and we're very focused on kind of developing a global banking strategy where we're kind of like, we're working with the top banking institutions that have, the safest kind of like, the biggest balance sheets and almost the kind of safest place to kind of park our funds overall. And so there's a need for that just from a just a direct access to liquidity standpoint, which is critical for kind of real-time mint and redeem capabilities. But I think also, post-banking crisis, diversification and having a broader set of global banking partners that covers all the regions that we want to operate in. That's kind of another key goal from us, just from an overall kind of USDC and kind of broader stablecoin access standpoint. But I agree that things are going to evolve, and this is a starting point. And I think there's many more chapters that we'll see rolled out, I think.
Guy, from your perspective, and you've obviously continued to increase the usability of your stablecoin in places like being quote assets or collateral assets, and places like Bybit and others. How do you think about it from being a decentralized protocol in terms of dealing with or not regulation?
Yeah, I think with Mika in particular, there's an exemption that they carve out for DeFi in particular, because I think we could even see just coming up to, I think, the tightness of the deadline, even when Circle came to announce things, people hadn't really got things in order even until the very last minute there with the largest issuers in the world. So I think they've given a bit more time for DeFi to sort of get their arms around it and try and come up with some framework. So the way we've set ourselves up is be maximally flexible to be able to respond to that if and when there is more clarity around it. I think the other thing that looks slightly different here is that the actual asset that is backing the stable that we issue is obviously looks different in its construction, i.e. it's a crypto asset and not explicitly a security like a treasury. And so you might fall under some sort of asset reference token rather than e-money in that framework. So, yeah.
And are you concerned at all about what's happening in some of the bills that are coming out in the U.S.? So the Loomis-Gillibrand bill had a ban on quote unquote algorithmic stablecoins, but didn't really define what that means. It's a lot of these conversations has been, okay, well, if it's going to be U.S. dollar denominated, then it has to be backed maybe by just a bank deposit or just a treasury. Are you concerned about that at all? Have you thought about what the U.S. market might look for you in the future, if at all?
Yeah, we've made a very explicit decision to carve out the US entirely from our user base. We have no nexus there in terms of even exchanges, so not even on Coinbase. So it is just a market where there's not enough clarity for us to be able to offer the product that we do, which is unfortunate. And if and when that does change, we might be able to reevaluate that. But at the moment, it's basically zero exposure to the US.
So this is obviously a lot of conversation around regulation, which I know is a boring topic. But I think, if we look at the history of regulation, it often has the effect of entrenching incumbents or entrenching kind of large-scale players that aren't necessarily pushing forward innovation. Is that likely to happen here? What do you think, Guillaume?
Well, no, we're the proof that incumbents can do something and innovate. I'm pretty sure the regulatory environment in the US is a big break for innovation for like other banks like ours, right? Tier 1 banks who are only waiting for clarification before doing something in the space. So it's going to happen at some point.
I don't know if you have a point of view, John.
Yeah, I mean, I think local regulation of global assets, right, should be inherently competitive between governments to sort of attract businesses and sort of attract additional activity. I think we're early, again, as with everything. I think it's interesting that Mika has come into being now and has sort of put, a pawn on the table in terms of the chess game that this is, and I imagine the US will respond. Stripe obviously just has to operate under whatever regulation kind of comes into being from that standpoint, but I think there's optimism in general around it, just from the standpoint that the first version of the bill is unlikely to be the last version of the bill, just like the first version of the regulation is unlikely to be the last version. And I think being a global asset, being like global commerce, and the more we see cross-border commerce happen, I think we'll probably see more like government competition over what sort of attracts the players that are acting, in the most accepted and kind of adopted ways. So in theory, this should be a healthy moment, right? I think we'll kind of look back at this as the moment that these things start to solidify and we start to get clarity, as opposed to sort of, the moment that things go more chaotic, I hope.
If I can add, in Europe, I'm hearing multiple projects from banks to also launch a stablecoin. I personally think it's going to take a bit longer than expected. Reason for us, we managed to be there on time is we've been experimenting on Ethereum for 4 or 5 years already. Our compliance, which is SG Forge compliance as well as the banking group compliance, I've been using softwares like Elliptic and Chainalysis also for years, and they're able to track what's going on. They understand it, and they've been doing it for a long time. Without that, it would be impossible for us to say, hey, the token is transferable as of today. It's a long process.
And why do you think you've been able to get comfortable with Ethereum or public chain in a way that other banks haven't been able to?
I think it was just a choice, like decision from the start. Like, what are we doing? Like, do we believe in having like our own private blockchain? No. Do we believe in like some of the consortiums? Maybe, but that was also expensive. And the way to start experimenting was like, why don't we use a public infrastructure that is not going to cost us anything at the beginning? This is how we started and built on that. That's the right philosophy from my point of view. And that brings us where we are today.
That's great. And so, John, you kind of mentioned this about the different localities or geographies and looking at what the local regulations are. Has there been, regulatory bodies in different parts of the world that have made it more attractive for you to do business with crypto than others? Or is it more just, hey, we want to do business everywhere and that we operate already currently, and we'll just figure out how to be compliant in all of those geographies?
Yeah, I think it's too early to tell. I don't think there's enough clarity yet on the global market to sort of have a company like us have a preference in any direction. I'm sort of hopeful that becomes more obvious over the next couple of years. But I mean, unfortunately, the short answer is no. I don't think there's like any one geo that we look at and we say, well, there we go. There's where we need to go and base all the operations out of.
All right. So we're almost up on time. We've got 4 minutes left. So I want to give people a little bit of space to talk about what their crazy biggest prediction is for stablecoins for over the next 10 years. And we'll go down the line. So maybe we'll start with you, Guy.
Yeah, sure. Don't know if it's actually that controversial, but if we think about what sort of gives Ethereum value, I think you've got trading shitcoins and then basically storing and settling dollar transactions on chain. I think a lot of the values of Ethereum is being leaked to other chains in terms of the trading, whether it's Solana or somewhere else. And actually, the core value proposition of Ethereum moving forward is basically just going to be the storage and transfer of dollars on chain at size. And so given that, I actually think at the moment, you see around 20% of the market cap of Ethereum is stablecoins in terms of like the ratio between stablecoins to the value of Ethereum. I think that number is going to flip and stablecoins are going to be more valuable in aggregate than actually Ethereum. And the issuers of stablecoins are going to capture more equity value than Ethereum itself as well.
Yeah, I would say I have a few. So 10 years from now, I think stables are a $5 trillion asset class. I think the largest stable is a neutral issuer that's not named Tether. And I also think there's 3 issuers that have at least 500 to 750 billion in AUM.
Tough to predict 10 years from now. But something crazy, maybe like the death of centralized exchanges. Using stablecoin just to on and off ramp, and then use like DEXs and broker-dealer connected to all these DEXs to do your trading in crypto.
Yeah, I was going to I'd say we're on track to trillions in the kind of like years to come. I think we just talked about kind of 4 or 5 use cases that have addressable markets that are in the trillions of dollars. So I think like even a small fraction of kind of eating into those, which I think stablecoins already have like emerging product market fit, I think we'll get to those numbers pretty easily.
I think maybe less than just like the stablecoin growth side, but in terms of like the limit, I think, of a rapidly growing sort of global economy and like global commerce that we should see out of the growth of stablecoins, I think we'll probably also see a step function in global merchant sort of transacting volume growth. Where we'll start to see like local merchants in long tail countries that we maybe otherwise would have overlooked, building startups, building large multinational organizations, and being able to stay in their original location, as opposed to needing to relocate to the US or relocate to the EU simply to operate within like the financial infrastructure that's required at that type of scale. So in theory, right, if we get that growth and you can enable a Nigerian businessman to go and grow a global business that maybe he already has today but can't scale from his locality, I would expect to see sort of a step function and kind of the scale to shift a little bit there from kind of the maybe like the US-centric unicorn startup world, maybe start to tilt a little bit towards some of these more long-tail countries producing those same types of entrepreneurs.
Great. Well, 1 minute left. So is there any audience questions? We'll take one. No. Okay. All right. We'll give you all the 1 minute back. Thanks, everybody.
Well, thank you.